Hey, everybody. Welcome to Market Mavericks. I'm joined by Scott and Mike. How are you guys doing today?
Great,
Oh,
thanks.
Good, good, good. So we have a lot going on. We're seeing the NASDAQ have one of its rare down days here. It seems like something that never happens. But today we are seeing mega cap sell. We got the CPI data out this morning. Bitcoin's been kind of flip-flopping around after that recent sell-off. But let's start with the CPI data. I'd love to get your guys' input. I mean, are we really starting to see maybe deflation, or is this kind of a rare flip over to minus 0.1 on month over month that's going to reverse? What do you guys think on this?
Mike, what do you think?
yeah. I was wondering if you want to. I think this is part of the macro, bigger picture of enduring deflation, worthy of the inflation, just getting started. And the only way we're going to get deflation is the stock market has to go down. So maybe if it stays up, we're okay. But if it stays up, the Fed's less likely to ease. And what I think is happening now is the market's starting to realize, okay, the Fed can ease. We have 100% that it can ease at that September meeting. And the rising unemployment rate can somewhat justify that. We still have a lot more data until that happens. But today's number, I think, is just, it's just noise and bigger picture macro, which, things I've been pointing out is, we swung way too far towards recession last year, way too far towards no recession this year. And we're just swinging back in the middle now. And I think the best leading indicator on the planet, Bitcoin, had a great run up earlier in the year, but it's still showing weakness. I think it's just indicating to you that, we just need a little backup in equities, let the dust settle, and then see how things pan out. But from my standpoint in commodities, this is just getting started. I mean, grains are usually the most elastic commodities. They lead everything. They've broken down hard. I can show you a few charts on that. And it seems like everything should follow. So I don't know what saves us, but I can see a lot of just normal mean reversion in equities, in Bitcoin, and bond yields going lower, just following China. And I think it's just getting started. And gold, to me, is one of the best indicators that gold's pretty close to an all-time high again today.
Yeah, and we're seeing, I
I
just brought
think
up
that's one
the
of the most
Fed
enduring
watch
ones.
tool here. So
Yeah.
basically 85% chance they're going to cut in September now, which makes sense. I mean, I don't know how many people out there listened to the testimony or heard the highlights from Jerome Powell over the last couple of days, but he was basically saying that the Fed is seeing what they need to see, the job weakness. He's watching that closely, and he basically guided that we would see probably a rate cut in September. So I think that's what we're seeing here in reflection. I would just note that we're actually pricing in now 3 rate cuts by the end of the year, potentially. Do you guys think that that's a possibility? You think we will get 3 rate cuts by end of year?
I don't, but I'm
I think
afraid
so.
of. In Scott. We've been through that so much. Right now, they're still priced for over 100 basis points in 1 year. We see that since the beginning of 2023, and they hiked another 100. I think the prerequisites for cutting rates have already priced in the market so much. We have such an expensive equity market. To me, that's the difference now. It's not so much what they do as how much is priced in. And then when it does start happening, we might have more days like today where, okay, great. Now you're going to start cutting rates, but we know what that means, that unemployment was 3.4% last year and is at 4.1% now is probably heading to 6%. There's really not much you can do about it.
Gotcha. All right, Scott. So I got to ask you, I've been wondering about this for the last week or so. What is Bitcoin doing? Is this just normal to you? Is this, are we seeing something where it could actually break below this 52,500 level? I mean, give us your rundown.
I mean, it could. First, just a quick note on, I think CPI and inflation. The notable headline there is that it's the first time in 4 years that we've had month to month, but it's minus 0.1%. I mean, as we were kind of talking about before, Mike laughed. It's a 0.1%, right? Yeah. And expectation was 3.1%. It came in at 3. Not really a big deal. I think that people are just looking for literally any excuse to allow the Fed to cut, right? And so it's just more fuel for that fire. And I think that's why we've seen this massive sell-off in tech. But I think the story there, which maybe we talk about after Bitcoin, is that it is actually a rotation and not money necessarily exiting the market.
Yes.
Right. But that's something we can discuss. As far as Bitcoin, it is still only a 27% correction from the top, from peak to trough 74 over here down to about 53.5 at those lows. I mean, that would be a average correction in any previous bull market. That doesn't mean that it can't be rolling over. But, we're used to previous bull markets in this part of the cycle having 35, 40, 45% retracement. So 27% tough to get too upset about. That said, like technically, I think we all would like to be back above this 200 MA. It looked like it could get there both the last 2 days. These are pretty nasty candles, right, for now with rejections there. And really want to get back in that range where it was trading before to feel a lot more confident. Could it go below 52? There's no way you say it can't, right? But even then, it's just unless the whole market and everything seems to roll over, I don't see a reason for this cycle not to continue to play out with the election, the political tailwinds, the sort of built-in expectation of the halving and all of those things. So I still see mostly tailwinds for crypto right now. Just the boring summer doldrums, and it's coming, and it still sucks for most people because they have no patience.
Yeah. What do you think? I know you've been kind of a proponent of saying that Bitcoin isn't really following the equity markets, which kind of makes sense because we saw all-time highs as early as yesterday. But the one thing I would just point out here, which is kind of something that I've been kind of playing around with, is that if you look at the equal weight, it actually is very closely following Bitcoin. And I wanted to share my screen really quickly.
I had the S&P equal weighted, which was interesting for today, but yeah.
So we know Bitcoin made a high back in March, right? And that was its all-time high. And that's the same point where the equal weight S&P made a high. And then you had this secondary high over here, which mirrored Bitcoin. And then kind of the only difference is that Bitcoin's kind of rolled over. The equal weight's actually catching a bid now. But I just thought that was kind of interesting to notice that it's almost like Bitcoin's not in the group of the mega caps. It's not the sexy mega caps like Nvidia, but it still seems to be a little bit following the equal weight.
Mike makes a very good argument for it being a leading indicator, right? Yeah. I don't necessarily agree, but he makes the argument. I think the flip side here is that we know exactly what's happening with Bitcoin, and it happens every time we have extremely transparent selling pressure. I mean, the German government's been selling 300 to 500 million tranches on a daily basis, and they're about to run out. We saw exactly what happened after the ETFs were approved when we transparently watched GBTC being sent from Grayscale to exchanges and sold off, and FTX sold $1 billion of GBTC when that unlocked. That kind of sustained selling pressure, although it's nothing in the long term, which I always kind of say. Obviously, in a low volume, low kind of volatility summer market, it's going to push things down. And of course, when people see the Germans move, they panic and they sell ahead of it. But these are very short-term temporary things. They have less than 10,000 Bitcoin left. They sold over 3,000 Bitcoin, I think, just today, maybe even more. So they're running out. I think that's why, listen, if you believe it's correlated to the equal weighted index, I would say the reason it's temporarily not is because there's the German government selling, right? And maybe it rolls right back to looking at that correlation. I don't know, but right now Bitcoin's going down because there's someone selling a whole lot of it.
Interesting. So one thing I wanted to ask you too, before we head back to some macro data is, so Ethereum, I've been watching CNBC in the morning, getting ready for work. And basically I'm seeing these Bitwise commercials for the ETF nonstop for Ethereum. And do you have any information on that? And do you think like we could see a run up because of that, or is it more of a wild card?
I think we saw the run up when they were surprisingly approved. We added, 30%, I think, to Bitcoin to Ethereum in a matter of 2 days. I had Eric Balchunas and James Seyfert on my show yesterday, the two ETF analysts from Bloomberg, specifically talk Ethereum ETF. They think July 18th, their best guess for them to start trading. So that's a week from today, but they also thought that there was a likely chance they would have launched a week ago. So they say take it with a grain of salt. We don't really know what the SEC is doing here, but they are coming. Listen, it's going to largely depend on what Grayscale does with their fees on the Ethereum trust, right? We saw that there were a number of reasons why people were selling GBTC after the approval, right? You had the people that were playing the discount trade. You had the people that had been locked and just wanted to get out. And you had people who were seeking a lower fee than 1.5%. If Grayscale comes in at 1.5% again and everybody else is at 19 bips, we're going to see a massive sell-off of the 8 to 9 billion in AUM of Ethereum. And we're going to get that sell the news. But once again, it's a fundamental, like you can watch those coins being sold. That's the transparency of this market. But if they come in with a competitive rate, and I think they're going to launch those Ethereum minis, maybe we don't get the massive sell-off from selling pressure. But listen, 8, 9, 10 billion, depending on the price in ETH, That's a lot of Ethereum relative to the market size, even more so than the 25 billion that was in GBTC was to the total size of Bitcoin.
It's a good point. And I guess one of the things that I was curious about is if they do come out with a 1.5% fee on that. I mean, can they? I mean, I guess the question would be is, can they come out with a lower fee if they're charging their Bitcoin people 1.5? It almost to me would be like an insult to those Bitcoin people, and those people would be like, "What the heck?" If all of a sudden they're like, "Oh, we'll only do
I don't know.
point whatever."
They had a turnover in management, right? So Michael Sonnenschein left after all of that happened. I don't know if that was the reason. A lot of people point to it, but I do think, they tried to rectify that by launching that Bitcoin mini product with a much lower fee. And I think they might do the same thing with Ethereum. Listen, I think if you're just a betting man, you say it's going to sell off at first and then climb. That's what happened with Bitcoin. We'll see.
Gotcha. Mike, what's your take on Bitcoin here? What are you thinking?
Yeah, let me show you some few screens. I got a little macro overview I want to show you. First, this is just take a simple measure of Bitcoin versus a 100-week moving average. It's breaking down. You see the S&P 500 versus a 100-week moving average. It's just really expensive. Most rational traders don't buy there. They just look for spots to, you ride it for a little while. You look for put strategies. Also a key thing I want to show you about Bitcoin. Again, this is the key thing I've been pointing out for a while. It's that divergent weakness. Bitcoin versus gold. It's been breaking down when it should be breaking out higher. And this is overlaid with the S&P 500 E-minis. 2 gaps below the market. Since 1997 on a weekly chart, we've never left one gap. Key thing that really struck me in 2007, I focus on this a lot, and this is just look at volatility. S&P VIX volatility index versus T-bills, a 52-week moving average. It's very low, potentially bottom. And again, Bitcoin versus S&P 500, it's breaking down. And on a pure technical basis, it's about 10 right now. There's no reason it can't get back to 7. It doesn't mean anything in the big picture. But I want to tilt over to something I think that's really significant I published today. The Economic Surprise Index in the country is tilting over the way I think it really should. It went too far the other way. Now we're seeing all the signs of that overdue recession just starting to kick in. It's at the lowest in about 10 years. Now I overlay this with gold versus the S&P 500. Gold is just so cheap versus S&P 500. Just a little pop up should do that, and it should happen. I think it's just a matter of time. It's what I'm showing here, but I want to show you a few others, and I'll lay low and see your response. This is something that's just happened the last week. Is you look at the gold versus a Bloomberg commodity spot index. I mean, I can go back 60 years on this. Resistance since 1988 that only pumped up a little bit during COVID is breaking through. Gold's breaking through versus commodities. To me, that's a sign of what's really happening in the macro. We have a war going on. It's hot and cold. President Xi and President Putin, NATO's all over today. And that just makes gold shine versus everything, most notably commodities. I want to show you one other thing that's part of the reason I'm still very bullish U.S. long bonds. I think TLT might be one of the best performers in the second half and then for a few years. And that's corn is one of the best deflation indicators. Corn's breaking down. I overlay it with crude oil. Corn's gone back to 4. First traded there in 1974. I was 10 then. And that means crude oil is probably going to go to 40. This is crude oil first traded 40 in 1981. Iran's, when we had the Iran-Iraq war. Here's another thing, grains. Grains are the best leading indicator for all commodities, and commodities are a good leading indicator for inflation. Grains have broken down to a level. If commodities drop another 30%, they'll catch up. To me, it's just a matter of time that happens. And I'll end with this. I want to know you anymore. Is things that always happen in commodities is they go down because they went up. It's autocorrelation. It's what always happens. And the question is that force more powerful than ever? And I'm pretty sure it is. This is what I just show you as a Bloomberg commodity index versus a 60-month moving average. It's breaking down, and we still have Fed funds at 300 basis points above PPI, or you could say PPI 300 basis points below Fed funds. That's very restrictive. So at some point, the Fed's going to have to start easing. And they will. They'll be reluctant because we've had the worst inflation of a lifetime, which you see here. This is the spread between PPI and Fed funds. And then we start that new trajectory. I think really favors. They're catching up to deflationary trends, which are tilting lower, and they have multi-decades of forces going that way, certainly after that big pump. And the number one bottom line is, if the stock market just has a normal 10% correction, the deflationary dominoes tumble. I mean, they just start kicking in unless some kind of war or something spikes crude oil, which is bad for everything. So the way I see it is Bitcoin's kind of indicating that this is going to be happening by showing that divergent weakness, by sustaining below its 200-day moving average. And if S&P 500 catches up to its upward sloping 200-day moving average, which it always does in bull markets, it's about a 10% correction.
I'm assuming, Mike, what you're thinking is you say that deflation comes on if the stock market has a correction is because the move up in the stock market has been creating a wealth effect that has kept the consumer spending. But if that goes away, then essentially the last area of the public that's spending is people invested in the stock market because everyone else is suffering, right?
It's wealth effect multiplied by many X's. We are the most exposed to the stock market any time in history. Virtually every person in the world and in this country certainly has related to a 401k or indirectly, but it's a psychology. I remember it very clearly in 2008. Once the stock market going down, and I lived in Fairfield, Connecticut, a wealthy area, and the spending just shut off instantly. And once people don't see their statement, see it's giving back 20%, it's not going up right away. Even their house that doubled in the last 10 years is trickling down, and it shuts down everything. And we're just overdue for a normal cycle. Maybe it's starting soon. I think it's going to be starting this year. Maybe Trump will save us, but the market's priced for so much optimism. I'm just pointing out the potential for a little bit of normalization. And maybe that starts today. I don't know. Today's just a normal little backup, but I think Bitcoin was the best leading indicator after the great financial crisis. I think it's perfect to show us where we're going to be heading in the next few years.
And Bitcoin, let's be fair, Bitcoin was a great indicator of the top in 2021 in the stock market. I think it topped about 6 weeks prior to the stock market. So it's just something to keep an eye on there. So I think, by the way, Scott, just to throw this out to you, I just saw that Trump is going to be speaking at Bitcoin Nashville, right? You're going to go and hang out?
I'll be there. Don't think I'll be hanging out with it. I think I'll be probably avoiding that actual part of it, like the plague, not because of any particular feeling about Trump, because God, who wants to be in that crowd at that time? I don't know. I know exactly what he's going to say. I'll watch it on TV from the next room or something, or maybe from the press room. But yeah, I mean, listen, like I've said, the political tailwinds are insane for crypto right now. Yeah, and that's why it's really hard for me to get bearish. The only reason I can get bearish on crypto is if we have a full-on, recession, depression, or the market completely rolls over. And I think we would all agree that when that's done, if it happens, crypto is going to be where you're going to want to be to the upside, right? Yeah, so even if it gets disproportionately wrecked, we know what happens after that, right? I mean, 2020, talk about Bitcoin being a leading indicator. We've said this, but March 11th at 2020, Bitcoin bottomed under 4,000. Could have gone to zero on BitMEX if they didn't turn it off. Stock market bottomed 11, 12 days later, and then stock markets went up 2.5% over all these years, and Bitcoin, went up 17 all the way back down, up another 18. It's just insane how hard it moves. So I think that's where you're going to want to be. What I find interesting today is, again, just to circle back to that point, is that, the Q's obviously having a relatively terrible day, wildly overbought, bearish divergence, like all the reasons to believe that this is topping for now. But once again, sort of like when NVIDIA topped and the money rotated into Apple and Alphabet and all of these, and Amazon, which made their own highs afterwards, we kind of feared that if NVIDIA rolled over, everything would roll over. Now the Q's are rolling over. But here's the Russell, right? IWM is absolutely pumping, which means that people are taking their money out of the easy, predictable, big tech trade, in my mind. And they're actually going for the things that were disproportionately beaten down because of higher for longer. The idea that rates could come down, these smaller companies could actually do well. They're starting to now. So it's like, this isn't risk off to me.
No,
this
is
like
not.
Riskier on to a degree, even though we're seeing sort of SPX and Qs have their first 2% down day and God knows how long, right? I just don't see money exiting the market. This is like another level of hysteria in my mind.
Yeah, and I think you're 100% right on that. And I think it's important to recognize that, like, until there's something that really scares investors, being invested is the key, right? I mean, even fund managers, and Mike, you can speak to this more, but fund managers can't just go to cash, right? They lose their jobs, they lose their investors if they go to cash, right?
Yeah, so that's one of the things I've been enjoying, and it's been 20 years once you've had about 20 years T-bills this high, and it's every single peak. It's been the same, and I've really gone back and done a lot of my reading lately. The latest book I'm enjoying is American Capitalism by Alan Greenspan. And human nature and cycles never change. And this is just one of the most extreme I've ever seen. I don't know how many people said, yeah, I made some good money in Bitcoin, so I put it in SPYs to preserve it. I'm like, you can get 5.3 in a T-bill. And then it's also the concept in equities. People in equities don't even consider going to T-bills. They said, yeah, I'm going to just go from growth to value. I mean, that's what's going to change. You have to have a period historically always where people give up and say, yeah, maybe I should be in T-bills, and they'll be at 1% by then. But it doesn't ever happen. Markets never peak when people are really bearish. They always peak in similar to environments where we are right now, where you can't consider anything else. And if you don't keep up with your neighbor who's outperforming you, you're fired. And if you're money manager, it's just the way it's always worked. And then I always point out the things like the volatility I showed you. You just don't want to be along the stock market when the volatility is at a 20. Here I don't go back to 2007. Once at almost a 20-year low, volatility is always mean reverting. And T-bills at almost 20-year high. You find alternatives, and that's why I think gold's going to start kicking in. So the second half in this year, I think the market's going to realize, well, shoot, this AI-driven S&P 500 is up only 18% this year, and gold's up 17%. It's a lower volatility. No one's really talking about it. Which one should I look forward to? And obviously, I'm a commodity guy. I have to admit, there's not many commodities I think are going to go up in the long term. But I think gold has got the deepest pockets in the planet buying it. There's a war going on. These people are involved in the war. They're selling. They have been selling treasuries. They're printing money and buying gold. I think I'll go with that trade for now.
Do you guys think that, so let's say the deflation narrative starts coming in, we saw this little CPI downtick, 0.1%, obviously not much, but do you think it just creates this narrative that the Fed can then latch onto that says, okay, well, we can start expanding our balance sheet again? And the government, I mean, there's no one running for re-election or even anyone running that's like, hey, we got to get spending under control. Like, it is just not even talked about. And my big fear is that we see deflation, right? There's literally, that just gives them a green light to go print and spend even more.
Yeah, I mean, wouldn't the smart thing, Mike, at this point be, though? I mean, you and I have both been on the same page, all of us, for a year and a half, that there was no reason to cut, no reason to cut, no reason to cut. I still think there's no reason to cut, but I think that they want a reason to cut, so they're going to go find it at this point. So I do think that by the end of this year, politically, we're going to get it. Wouldn't the move at this point be to just do a 0.25 cut and then do nothing for another 6 months?
Greenspan did that.
Throw the Lions their red meat, feed them the rate cut, but then basically just continue to pause and let it all shake out.
So part of that, I want to follow back. I love the concept when people talk about the Fed put. The Fed put comes only after you get maybe a 20% decline in stock market. And that's why I was showing on this chart right now is we still have the S&P 500 25% above its 100-week moving average. That's a pretty significant speculative frenzy. I'm sorry, it's above its 100-week, 100 moving average. The Fed does not cut in that environment unless they want to add fuel to the fire, add alcohol to the punch bowl. That's what happens when you cut in that environment. Part of the reason they're reluctant, but it's also an indication of really antsy type A, markets who are just could not wait, way ahead of themselves. They've priced this so much in. They've priced in all the good stuff that you have to expect normalization. And that's when I'm afraid that they might, who knows how it's going to work out. But I think it's more potential. The risk is we might be similar to like Japan when that stock market peaked in 1989. It took a long time.
I was just going to say, should we talk about Japan? I have the USD JPY chart up too, Gareth. What a move.
Yep.
Correction in the bear market. Well, price going up, bear market for the yen. But
so yeah, speaking of this, I just want to show people this. So check this out. So you take the low from December of 2023, just connect it through these lows and look at where the dollar yen went to again, and then extend a parallel right up here. And you can see right here to here and right here. And we didn't get quite back there, but look at how it dropped right into that level today. And that was, again, on the back of the CPI data this morning where it fell. Japan's probably rejoicing at that because I know they've been having to almost intervene again and potentially be labeled a currency manipulator. But I guess this is the key, and I wanted to bring this up, and I appreciate Scott kind of walking us into this. But you have 250% debt to GDP, and all of a sudden we're seeing, I think I saw, Mike, you might know this stat, but the real wages in Japan have declined for 26 straight months. So essentially, even if they're getting paid more, they're actually, the real wage is less because inflation, because they import almost everything. And so if their currency is weakening, everything costs a lot more. And where's the end game here? I don't see it. Is there, how does Japan get out of this scenario?
It's worse in China. and China's bigger. It's just that's how bad it is getting. And I think I appreciate you pointing it out. Is obviously that the yen's backed up a little bit. Finally, I think that just squeezing some of those excessive shorts out of there. People short the yen back to trend, but the macro is unstoppable, and that is what has driven dollar strength versus the rest of the world since 2009, and that is the U.S. stock market outperforming the world. Is it driving it? Is it coincident? But they're all going together. That to me is the lose-lose for all risk assets. The dollar is breaking things. We're seeing that with the yen, which is coming back a little bit. It's going down today partly because the stock market's going down, but that's to me the problem. Is the U.S. stock market is keeping U.S. interest rates high. It's making the dollar strong. It's crushing countries like with their currencies like China and Japan and Europe, and so that means when the key thing to really is reversion in the stock market, U.S. dollar, all potentially means everything just has to have a little bit of normal correction, and maybe you're seeing it there. But I wanted to show you key thing is I look over at the bond yields in China at 2.25%. The Chinese government has been trying to make yields go up, but there's such a flight to quality. From my colleagues in Asia telling me that there's such a flight to quality everything, they're buying bonds, and they're 200 basis points below the U.S. 10-year. I think it's just a matter of time the U.S. goes there. Now, yen's finally got a handle. I got a one handle on the JGB 10-year note, but then you look at the whole rest of the world curve, and I think, yes, when people point out the U.S., the deficit, I agree, it's a problem, it's unsustainable, that's part of the reason I'm bullish gold, but every single time people said they can't buy U.S. treasuries because the deficit has been wrong, and I've only been hearing that since 1988 when I started in the business. And I look at the rest of the world that says U.S. yields are really high. What's going to take them to go lower? Just a little backup in the stock market.
Yeah, so I think that's what I'm kind of dealing with now is that, how do people position their portfolios? Like, do you diversify out with stocks still? T-bills.
What's wrong with
but obviously
CLT from when we started the show in October at 84, just killing.
No, to me that to me is going to be okay. Let's put ourselves at the end of the year. Trump presidency, TLT and gold start outperforming, and then just have a normal backup in the stock market. To me, that's what's going to happen. Stock market can end up in a year 10%. It's still a great year, but that to me is where everything is. You have to look at the assets that are the most beat up on the planet, and that's U.S. Treasury long bonds. And everybody hates them. It's when you look, how was GBTC 2 years ago? To me, that's what we have to look forward to. And what changes that? I don't know, but the bottom line is that to me is the next potential big trade. And I'm just curious what stops it. And that's why I'm kind of watching crude oil very closely. I think it's going to tilt downward, and I just don't know what the catalyst is going to be. Now, it's probably going to take some kind of supply shock, hopefully not related to violence potentially, for that to not happen, because that's what always happens with commodities, and that's part of that deflationary reversion, which is normal after this inflationary spike.
Do you guys think the PPI is going to come in equally as weak tomorrow in terms of better than expected, or do you think there's some inflation creeping in on the producer side?
Well, I just want to add, piggyback on that one quick. There's been a trend for a few months now of inflation numbers and economic numbers becoming out weaker than expected. To me, that's what normally happens. So for PPI tomorrow, we have the market's expecting a 10th%. Man, let's look at year over year. Final 2.3, 2.5% ex food and energy. I mean, that's Fed funds are 300 basis points above that. But to me, the trend has been towards weaker than expected data, because I think it's normally how it's expectations versus what's happening that really matters. And that to me is the tilt towards what I showed here first, is economic expectations are collapsing. That's a sign of a normal market that is retrenching consumers. And you see that everywhere. Certainly my commodity space, I see the demand for diesel, unleaded gas, and container boards. And then we still have things like leading indicators, inverted curves, all the stuff we pushed aside and forgot about. It's just a normal cycle to go back that way. And remember, the Fed hasn't cut yet. You need a long and variable lag to cut for cutting for that stuff to get better, for the consumer to start spending. And if the stock market starts going down, all these things that are already trickling down accelerate. And I just want to point out that's, from a commodity standpoint, we're seeing the acceleration of the declining pricing of the grains, and they usually lead commodities, which usually leads inflation and PPI.
Yeah, I just wanted to quickly show the corn price. Look at the drop in corn recently. Wheat is much the same. Incredible declines recently. And I was even pointing this out, is that if you look at something like nickel, which is obviously a big industrial component here. Look at the drop here, man. I mean, and again, this goes to at least what I extrapolate from this, and I think, Scott, you guys would agree, Mike too, is that this probably is a leading indicator telling us that smart money knows the economy here in the US is stalling and that China's not recovering, right?
Oh, well, you're going to see, definitely have to. China is going to do what Japan did. They've already started. Eric Balchunas, you mentioned, has already said they're going to start buying their own stocks. I mean, they kind of have to. Japan's been doing that for a while, buying their own bonds. But what's significant right now is actually been trying to sell their treasury bonds because they think yields are too low because people are buying them in droves. So that's why I wanted to show you this chart. Gold, you mentioned industrial metals, but it's all about what's happening versus gold. And gold is doing the same thing versus industrial metals. It's breaking out higher, and that's why I stick with, when you go with the gold, and it's taking the metal, and especially when it breaks out like this. And this is before significant events. Last time it broke out was COVID, so it's telling you something. And I'll just go with it.
Do you guys, I mean, last thing I'll say, and we can wrap it up, is you hear about governments like the really Federal Reserve banks or central banks, they buy their own bonds, right? I mean, they buy bonds from the U.S. government. I mean, isn't that one hand washing the other? And then you hear about countries buying their own stocks. Like, is this sustainable? I mean, isn't this something that it just seems like one hand washing the other, and it's unsustainable at some point?
Well, I just want to comment that and let Scott follow up on it. It's what's happening. It's that quote that we're turning Japanese. China is clearly turning Japanese. Japan owns a significant amount of their JGBs. They own a significant amount of their stock market, and it helped build it up. Maybe not as much. And China's starting to do it. So who's next? And what stops that?
What do you say, Scott?
I agree with Mike, and I think you made a good point. I think we can wrap there at the total.
All right. Perfect. All right, gentlemen. Well, guys, thank you everyone for tuning in to Market Mavericks today. And we will next week. We're not sure if we'll be here. I think Mike, you're away, but we'll kind of figure that out as we go. And if it's busy, maybe we can do it anyways. But either way, guys, thank you so much for tuning into Market Mavericks. Follow these gentlemen. You see their handles at the bottom here, and we will see you soon. Have a good one, guys. Take care.
Thanks, guys.